Hello and welcome to Rebel Finance School. We have a special edition. It is week 8 for Americans.
It is week 8 for Americans, yes, because we've got these funny accents, haven't we, that we are from the UK. So we wanted to think about and talk about, does this stuff that we go on about at Rebel Finance School apply in the States? And if so, how do you go about applying and implementing what we've been talking about for the investment part, which is what we've come onto in Rebel Finance School?
So we obviously researched the American market, but we needed a special guest to help us with this stuff. So we have a special guest for tonight. Please, everyone, give a huge warm welcome to Mr. Bob Haynes.
Thank you. Hello, everybody.
Who is this Bob chap, Alan?
Who is this Bob?
Where did you discover him and who is he?
Well, we used to run this event called Chautauqua, which was fairly big in the FI world. And Bob turned up with a very, very large telephone to Chautauqua in the UK.
I think it was the case, the protective case, because Bob's kind of quite a cautious man, isn't he? So he's like, let me have a phone case that will protect my phone, which is very sensible. And that's how we got to know Bob.
And then we met him at another Chautauqua. We've seen him twice at Economy. We've hung out in New York. And Bob retired some time ago and donates his time. He volunteers for Third Decade and does financial education for people in their 20s and 30s. And he shares what he's learned. And he's one of the nicest human beings we have ever met. So we're very grateful that Bob has come to help us with tonight's session. Bob, how has your investing evolved over time?
Yeah, it's a good question, Alan. I think before we found the financial independence community, we were doing a lot of weird things that I realized after the fact that I didn't have to be doing. So we essentially had multiple accounts across multiple different providers, from old 401ks and jobs that we had worked in the past. And we were also running horse races between different robo-advisors and a financial advisor. And I realized after reading a book by J.L. Collins called The Simple Path to Wealth that we didn't need to do that anymore. We were able to really simplify our investing life and go from many providers just to a few, and really consolidate our accounts down and invest in just a single fund to get there. And then since we've been retired, just a couple of funds now, basically an index tracker and then a bond fund now that we're retired. But yeah, things can be much simpler, once you've got the right education. And I know that's what you guys are passionate about with Rebel Finance School.
Yeah, it doesn't have to be complicated, does it? Just before we started the YouTube live, I was saying how I do enjoy admin. However, I do appreciate that's not everyone's bag, and actually the simpler it can be, the better. So actually I'm gonna say admin is not always what it's cracked up to be, Alan.
So we are going to do the USA session tonight, talking about all the different accounts and funds in America. That's the plan. But obviously, before we do any of that, we have to do your favorite part of the night, the disclaimer. Are you ready? This is not regulated advice. We're not regulated. Not even Bob. We're not trained financial advisors. Not even Bob. We're never going to try and sell you an investment. Not even Bob. You make your own decisions, sharing our opinions and ideas. These ideas may not continue to work for us or you or Bob. You are 100% responsible for the future. There are no guarantees here except
the money back guarantee. If you want your money back from this session, you didn't like it, please direct all your queries to Bob.
Obviously, if you paid, something went very wrong. Troy, if you paid to be here, speak to us afterwards. Investments can and will go up and down. We are not sponsored by Vanguard or anyone else. Do we get commission?
No.
No, we wish we did, because we'd probably be even wealthier, but we don't.
Bob, are you sponsored or get any commission from anyone to talk about anything we're talking about tonight?
Unfortunately not.
Tonight's presentation has been updated with the big, beautiful bill in mind. So Bob has done a lot of study about that. And we're actually going to come back to the 3 decisions you have to make when you are investing. This came from week 8, Monday session, which the first part was about how to choose a fund. And you've got to basically look at, how do I minimize fees, choose a global index fund, and avoid some of the weird stuff out there that people will try and sell you.
The next decision to make is which account or accounts to go for. And the idea of those accounts is to help you minimize taxes.
And then finally, we've got platform. The platform is where you actually go to invest, and your job is to minimize fees. Find one that has, well, actually minimize fees. What are we even talking about? America doesn't have platform fees. We were disturbed to find that out because we all paid platform fees in the UK.
Disturbed in the sense, just like jealous, basically.
We're just jealous of America, really. You have to get good customer service, get a good solid platform, and you basically need to avoid gamifying investing and just keep it simple. So that's what we're going to go through tonight. First thing we're going to look at is funds. And the question is always, which funds should I get?
So if you watched the main content session that we did on Monday, you'll have seen these different criteria that we looked at, and we're going to go through these and how it applies in the US. So the idea is to get a passively managed fund as opposed to an actively managed fund. We are not fans of actively managed funds at Rebel Finance School.
We talk about getting a global fund, which we're going to debate with Bob in a moment, whether you should go global or American. We talk about the asset types. When you're on your journey to retirement, you go 100% equities, and then afterwards you maybe switch to having some bonds like Bob mentioned in his intro. We're going to be covering that in week 10 of the course.
Yeah. We talked about avoiding ready-made portfolios and avoiding any type of bias as well.
And then index funds versus ETFs, which there's actually some differences that will be useful in America on that one. Then you've got accumulation or income. Are the dividends reinvested or are they paid out to you? And finally, minimizing fees. So those are the 8 criteria. If you want to snap a screenshot, you can, or it's in the course notes, or it will be when I've written the course notes later this week. So you've got that there for you. Bob, does this same framework for choosing a fund apply in America? Does it apply where you are too?
Yeah, I think you guys, I watched your class for the British version, and I was like, this is a very useful rubric for folks to be able to use, especially if they're looking in their own retirement funds where they might not have some of the funds that we talk about tonight available to them. They can use this rubric to figure out what is the best fund that is actually available in their plan to choose. So yeah, I think it's really useful.
Was there anything there that you thought like, oh, this bit, what about this bit? Which of those bits do you think really struck you?
Yeah, so I think having a passive index tracker is probably, number one. And then number 2, having low fees. And the good news in the US is that we've really had a fee war, over the last 50 years and really accelerating in the last 20 years, that it's like, Vanguard will drop their fees and then Schwab drops their fees and Fidelity drops their fees even more. And we'll talk about some of the zero fee funds that actually Fidelity has at this point. So the good news for Americans is that there are still some crap funds out there, but there are a plethora of really good index trackers that charge you almost nothing to be in them.
I love that. Bob, a couple of people in the chat saying your volume is a little bit low. I don't know if you could just click on your audio settings in the bottom corner and just see if you can turn your input level up. Whilst Bob does that, I'm going to set the scene because Bob introduced fees. What is a low fee in the US? Because we've been banging on about fees in Rebel Finance School, as we do, and we set this kind of comparison in the UK. So we said low fees as a total are less than 0.4%, medium fees between 0.4 and 1, terrible fees between 1 and 2, and then daylight robbery is St. James's Place, boo, and anything over 2%. But how does that compare to America?
Well, we're very jealous once again about your fee situation because low fees where you are, You're talking less than 0.1%. And therefore, daylight robbery is anything over that. Your fees are extremely low. You've got such a more developed market, having been around for so many years, and the fact that obviously you have a much larger population. So as these funds grow, they're able to put the fees down, because if it's charged as a percentage and you've got a massive fund in there with lots of people's money in there, they're able to push those fees down, as Bob was saying about the fee war. So if you're seeing fees that are more than 0.1%, run a mile.
You're paying too much. So on the decision levels with the funds, your options, we thought we'd just talk a little bit about USA or international, because we talked a lot on Monday night about this thing called home country bias. Home country bias is where New Zealanders invest in New Zealand and Auckland Airport. British people invest in British companies. Japanese people almost exclusively invest in Japan. And guess what? Americans almost exclusively invest in America, which is quite interesting. But you do have two very large funds that are available in America that we're going to talk about.
So firstly, there's VTI, which is the Vanguard Total Stock Market ETF. That is an American fund that invests just in American companies, and the fee is 0.03%. And then on VT is the Vanguard Total World Stock ETF. And we've highlighted World to show that's the global fund. And if you tuned in on Monday, we were talking extensively about the FTSE Global All Cap, the main content for week 8.
That's what this is.
It's the same thing. It's investing in the same thing. So you can see there that it accounts for 62%, or the US accounts for 62% of the fund, and then the rest of the world, 38%.
So that 62% is a chunky percentage. It is a large percentage. When you think about the UK is 3.6% of the global fund. We would be silly just to invest in our own country. It's a tiny percentage. And most of the companies in America are global companies. So if you think of the top companies, Apple, Google, Starbucks, whatever they are, they tend to trade completely internationally. And the fees on these, 0.3 for VTI, 0.03, 0.06 for VT, which is just incredible.
Yeah, these fees are incredibly low. For the equivalent in the UK, we pay 0.23%.
Yeah, which is just mad.
Should I stop saying how jealous I am about the fees? I just want to encourage people to see, to understand the context of what it's like internationally, but also to know that when you go looking at what the fees are on your investments that you might already have in your 401k plans and things like that with previous employers, just to understand that context, to know what a high and a low fee is.
So, Bob, can you talk to us about international versus US only? Do you own international? What are your feelings on this? Do you have home country bias, Bob?
Yes, I definitely have home country bias. And I think that, it went along with reading J.L. Collins' book, The Simple Path to Wealth, because of course, in that book, he recommends a single fund from Vanguard. It's VTSAX, also the ETF version VTI. It's the Vanguard Total US Stock Market. And I figured if that's good enough for JL, that's good enough for me. I will say, I've read, this is a highly debated topic within the personal finance community in the US. So there are very good cases on both sides of the ledger as to whether or not you're already internationally diversified enough by owning VTSAX. For example, 30% of the S&P 500 companies' revenues come from international sources. So that's also quite chunky. A lot of our big companies make a lot of their money overseas. The flip side of it is, well, I guess on the same side is, obviously there's been a massive overperformance of the US market in the last 15 years or so, primarily driven by the tech sector. But if we look at history, that happened in the past, that happened in the 90s, and then we had the dot-com bubble burst, and international really came back into its own. So these things tend to be cyclical. Right now, Amy and I really only have international exposure through owning the US market only. If there were one thing that I would change going forward, is maybe adding the total world in instead of doing the total US market. but I can see arguments on both sides.
So you'd be prepared to pay double in fees, 0.06%.
Yeah, 6 cents instead of 3 cents. Yeah. Right.
Because, we talk about how it's so important to minimize fees, but would you see that as an acceptable price to pay for the diversification of if you did choose to go global?
I think that would be an acceptable price to pay. When Jack Bogle was railing about fees, back in the 1970s, we were talking about percentage points, whole percentage points of fees, 1%, 1.5%, 2%, 2.25%. Now we're literally talking about 3 basis points, or 6 basis points. So it's such a small fee. In either case, it's kind of laughable.
Jackie from Tuesday for catching up to Fi in the chat says, I live in the US and I have home country bias. I get the feeling most investors in America do have a home country bias. I think we have become acutely aware of it because we live on a small country with a fairly small economy. So then you become very aware that you don't just want to invest in your own economy. You want to make sure you're globally diversified. There is an argument that you could say, well, we could just invest in America. But that to us would feel a bit weird, like 100% putting our money in your country. So we just went, we don't want to pick countries. We'll go for that VT, our version of VT. We'll go for that global fund. So that's what we did with that one. Yeah. So there you go. Those are 2 of the funds that come up a lot when you're talking about this stuff. And you're going, well, which one should I do? We had a lot of fun making the graphics for tonight, by the way. We had a lot of fun generating these. So
it's a bit like we've lent heavily into the eagle thing here, okay? So it's like the eagle is personifying someone figuring out this stuff as we go.
And they're thinking, do I go for VTI or do I go for VTSAX? Bob, talk to us about what's the difference between VTI, VTSAX? Those are the 2 funds that a lot of people talk about, mutual funds versus ETFs. Can you tell us a bit more?
Sure. So mutual fund is something that only gets priced once a day. Everybody, whenever you choose to buy it throughout the day, the price actually gets calculated at the end of the day, and everybody's transactions happen at once in the mutual fund. One of the big advantages to the mutual fund is you can put in any particular dollar value. The ETF is traded more like a stock. So both VTSAX and VTI are both the same underlying, the Vanguard Total Stock Market Index, but VTI trades like a stock, so there's a bid and ask spread. It trades throughout the day. Typically, what I say the best thing to do is you buy the mutual fund in your employee-sponsored retirement accounts, your 401k or 403b, your TSP plan, because that's typically where you'll see mutual funds. And then you can buy your ETFs in your taxable brokerage account. That way you have better portability if you need to switch brokers, and you have the capability to do some advanced strategies like tax loss or tax gain harvesting more easily.
So then just to be clear, these 2 things, you're investing in the same thing underneath. Just one is the ETF version, which is VTI, and one is the mutual fund version, which is VTSAX.
But it's the same companies.
Yep, it's the same exact companies. It's the CRSP Total Stock Market Index that Vanguard uses, and you're getting the same underlying exposure to all of the stocks in the US stock market.
And CRSP is one of the benchmark providers. They're the ones that are telling Vanguard, here's the list of companies that you should be replicating in these percentages, like the weighting that they should be using if they're going to be pure to the index, which They do try to be as much as they can.
Yeah, so the people who provide the lists of companies, you get the CRSP, you have one called MSCI, Morgan Stanley Capital, I can't remember what the I stands for. Exclusive, international, Agrarious, I don't know. You get So you've got CRISP,
You just made that.
MSCI,
It's even a word, is it?
and you've got FTSE, the Financial Times Stock Exchange. So you have, these are like the people who produce the lists, and then you have the people who produce the funds that basically track the lists, which is Vanguard and some of the other ones. So I guess that actually brings us on. Thank you very much. JC Morgan in the chat puts Morgan Stanley Capital International.
Well, JC Morgan would know.
Are you
That's
actually
amazing.
JC Morgan of Morgan Stanley Capital International? That's what we want to know. So as we move on, Bob, is Vanguard the only game in town?
It's actually not. They are the first game in town, but there are a lot of folks that actually provide index funds at low fees these days. So there are plenty of options out there for everybody.
And when we're talking about Vanguard in this context, we're talking about as a fund provider, right? So we think if you come back to thinking about the decision levels that we're talking about, there's platform, there's account, and there's fund. We're talking at this point about choosing your fund. Vanguard is actually also a platform. They have their own platform, which we'll come on to. But at this point, we're saying, okay, Vanguard make these funds, but also there's other people as well that you can buy.
Jackie in the chat says, love the Wall Street Bull on Bob's desk. Yeah, we love that photo too. It's absolutely awesome. And Andrea asks you a question. What about in Roth or traditional IRAs that's not with an employer? Should I get a mutual fund or an ETF?
Yeah, great question. It depends on what platform you're with, what you'll have available. Most platforms have mutual funds. Some platforms also have mutual funds and ETFs. So go with whatever your platform allows you to do. If you want to put all the money, every single dollar to work, some places don't allow you to do fractional shares. So the mutual fund is probably your best bet in your retirement account.
I love that. Now, in the FI world, which is the financial independence community, if you've not heard of it, JL Collins popularized VTSAX, and it became a bit of a meme. VTSAX and chill, just stick it in there and forget it. But there was actually some downsides to that, which we have found out about over the years. And we wanted to talk to you a little bit of the downside of VTSAX and chill and why you might actually want to just use an ETF.
Yeah, so VTSAX and chill is a great strategy if you're with Vanguard. The challenge is that sometimes if you're buying a different provider's fund on an alternate platform, for example, if you wanted to buy VTSAX in your Schwab account or in your Fidelity account, both of those companies are going to charge you $75 per transaction. So obviously, if you're doing a small transaction, yeah, if you're trying to put $100 into VTSAX, you do not want to pay a $75 trading fee to Schwab or to Fidelity. So the best bet is to either use the ETF, because VTI will have no such fee, or use the provider's fund. So Schwab has low-cost index funds, Fidelity has low-cost index funds. You can actually go with the provider funds that are similar to the Vanguard funds and not have to worry about paying that $75 transaction fee.
That's fantastic.
Finally, we found some high fees.
Which actually, it did come up from a lady that was doing this, and she was putting 150 in a month and paying the 75 fee to get it into VTSAX, and she didn't really know. So it's actually like a really important thing to know this stuff, because you might not even know that it's happening. So let's talk a little bit about the other providers. We've got Charles Schwab. They're one of the other providers, and the fund we have spoken about is the Schwab Broadmark ETF, SCHB. This is kind of similar, Bob.
Yeah, so this is similar to the VTI from Vanguard. And Amy and I use this as like a tax loss harvesting partner. I know that's probably a little advanced here, but effectively it is similar enough. It doesn't actually use the CRSP provider. I forget who the underlying index is, but it's substantially equivalent from a performance perspective. but different enough that you can do things like tax loss harvesting between VTI and SCHB.
I love that. Marta asks, are the names mutual fund interchangeable with index funds? What's the difference? I thought mutual funds are actively managed and a no-no.
Yeah, that's a great question. So I think sometimes they're used interchangeably. You can have active managed mutual funds and passively managed mutual funds, aka index funds. But to be specific with our language, I think saying index fund is the correct thing that we're actually looking for. So I apologize if I said mutual fund.
But it just becomes like it's difficult because there's so many different terms for the same thing sometimes. So like it's just one of those pieces. So like no apology needed. It's awesome, but it's just important to get that clear so that we make sure we are doing that. Cool. So we've got Charles Schwab, and then we did have a question in the chat as well, which actually brings us on to our next point. Bob, do you have any views on the Fidelity funds? Because Fidelity has zero fee funds. Like you can actually invest for nothing. Are you trying to make us jealous, Bob?
Yeah, I mean, that is pretty cool. I actually couldn't believe this. When Fidelity came out with this, I thought for sure it was going to be a gimmick. It would only be around for a year or something like that. But it's been several years now. It could be even longer. And they literally are charging nothing for these fees, for these funds. So this is great. This is a great option for those that are at Fidelity and know that they will stay in Fidelity. The challenge with the Fidelity zero fee funds are they're not portable at all. So you would never want to put them in a taxable brokerage account, even at Fidelity, because if for some reason, you got mad at Fidelity or you realized you could get a much better deal at Schwab or Vanguard or something like that, and you wanted to actually switch brokerages, you'd actually be forced to sell in your taxable brokerage account that Fidelity Zero fund. So it's not a bad option for your retirement fund, but definitely don't use it in your taxable brokerage fund because there could be massive tax implications in the future.
Yes. And just to be clear, like the difference between 0.03
What's not?
Sorry, 0.03 at a VTI versus 0 at a Fidelity fund, like it's not really going to affect your retirement that much when you're coming down to those tiny amounts.
Christopher saying, is there a Fidelity Zero fund that is exactly like VT, meaning a global fund?
Ooh, that's a good question. I am not that familiar with the Fidelity Zero funds. I don't know if Jackie might know the answer to that question, but I can try to look that up real quick. Let's see.
Well, let's.
Jackie's looking thoughtful as well. I can see her in camera.
Oh, here we go. Fidelity Zero International Index Fund seeks to provide investment results that correspond to the total return. Oh, it's of foreign developed and emerging stocks. So it will not include the US. So it'll be excluding US.
Yeah, so it's one of those funds that you would put alongside your US funds, which quite often you have like an international excluding US so that you can buy it to complement the other one. Sometimes the downside of getting two funds, though, is you have to rebalance it yourself, which can be a challenge.
Yes, because you're going to have to choose a proportion of, okay, what do I choose to put in international versus US? And then it won't automatically rebalance as to what's going on globally. You would have to choose whether you're going to stay with that same proportion or whether you're going to change it, which then you're in danger of starting to like have biases, right? And you're starting to try and choose which countries are going to do well, like you, or which regions, I guess, like US versus non-US.
Yes, which we have a big thing that we always talk about is don't pick countries. Just buy it all equally weighted, makes it a lot easier. Marta says, Bob, in my 401k, I have funds that look like index funds, yet there are names of fund managers. Does it mean it's actively managed?
Ooh, that's a really good question. I think that the best way to figure that out is to look at the fee. If you have a fee that's less than 0.1% or 10 basis points, then more than likely it is not an actively managed fund. The fee, typically, if you have an interface to go in and just sort by fees, I know a lot of times that's not the case, but if you can sort by fees, the ones that have the absolute lowest fees are going to be the index funds, and then the ones with the high fees are going to be your actively managed funds, just as a quick rubric to try to figure that out.
It can be tricky sometimes to work out. I've had that before. People have sent us things. Is this passive or active? And actually, it's not always that clear. And we've seen actively managed funds that have started to creep their fees lower, which you think, okay, is this all right? And I think the other thing you can do is if you read the description of the fund as well, like the first few sentences where it explains what it's about, you can start to kind of see one way or the other. And the other way is to just contact them as well, right? Like they'll have a customer service thing. You can say, excuse me, fund person, would you kindly tell me if this is actively or passively managed?
So we're going to move on to the next little bit, which is a chart from our friend Jeremy at Personal Finance Club. Bob, tell us about this chart and why you thought it was very important for us to share with the audience tonight.
Yeah, I think that one of the things that a lot of times people get hung up on is which fund, what is the number one specific, proper, correct fund that I should invest in. And when I saw this chart from Jeremy, I'm like, oh, this is great, right? Because effectively, coming out of this training tonight, you might have 1 or 2 or 3 different funds in your mind as to what you want to invest in. And the great news is, as per Jeremy's chart here, over the last 12 years, effectively any of them is going to be fine. So pick one and move on. Don't agonize over this decision as to what is the one correct fund. There are a lot of them that will give you very similar performance over time.
And this is just US funds, right? So this has not got international in.
I don't know if any one of, yeah, I don't think so. You're right. Yeah. These are all US based, either mutual or index funds or ETFs.
Yeah, so
BTI and BTSAX are both up there. Obviously, that's the same underlying fund.
Yeah.
Yeah, and VOO is the S&P 500, and there's quite a few famous ones on the chart. Next up, we have a little ETF comparison. Katie created us a little table.
Oh, I like tables. So almost as much as I like charts, Alan. This is a summary of the 3 ETFs that we've been talking about. So we've got the Vanguard US ETF, which is VTI. So is it US or global? It's US. What's the index that it's tracking? Well, it's that CRSP Total Market Index. What does that even mean? Well, that's 100% of the US companies that you can buy on the stock market. So any company that's publicly traded, you get that through buying VTI. So it's got 3,500 companies in it.
Which is actually a phenomenal amount of companies. And the fee is ridiculously low, 0.03. Then we move on to the Vanguard Total, which is a total world fund. So the benchmark is the FTSE Global All Cap, which is the one we actually can buy in the UK. It's the same. So you get to buy exactly the same thing as we do. You are invested in global, large, mid, and small cap stocks. So you own the USA, the developed world, and emerging markets. It is the full picture of the investable global world, or as close to it as you can get.
What is large, mid, and small cap, Alan?
So CAP stands for market capitalization, and it basically means the size of the company. So a market capitalization is number of shares times price of shares equals the value of the company. And then they split them into the 3 sizes. Large cap is like Apple and all the big companies. And then small cap is the companies that you've never heard from, Idaho or somewhere like that. I don't know why I picked Idaho, but it was just a place that came to my mind. Other states are available. Okay, number of companies you invest in this one, 9,914 companies. It is incredibly diverse, and the fees are 0.06.
0.06.
Thank you for translating.
Yeah. And then this Schwab one that we spoke about, that's a US fund. The index is the Dow Jones US Broad Stock Market Index. What does that mean? It's the 2,500 biggest publicly traded US companies. So number of companies, 2,500.
So it's not quite as diverse as VTI.
Correct.
And the fees?
0.03. So the same fees as you would pay for VTI, but you get slightly fewer companies.
So there you go. There's a chart of those three funds, just so you can see some of the differences and think through this. Spring in the chat says, I do love the naught. My Britishness does come out sometimes. I'm sorry about that. And then, so basically in the decision levels, when we're talking about funds, like any of those big funds will do you proud. The Vanguard US ETF VTI, the World One VT, the Schwab One SCHB, any of those will do you absolutely proud.
What's this ticker word on here?
The ticker just means the letters that you can Google or use on your platform to find it. It's like the code.
The code that identifies the ETF.
Exactly. Okay, and so that's what you can do. If you don't have one of those ETFs on your 401k platform or where you actually like invest, then you can use the criteria that we talked about, the 8 criteria, as a framework to make the decision about what to invest in. So there we go. That's where we are. We've done fund. We're going to move on to account, which this is where it gets super interesting. What is an account? An account is sort of a way or a space that you can grow your freedom fund in a tax efficient way. And then you get to America and you go, okay, what are the accounts? And you've got 401ks, 403bs, 457s, TSBs, traditionals, Roths, IRAs, traditionals, Roths, HSAs, taxable accounts. And then we're completely overwhelmed and we're going, what the heck is this overwhelming alphabet soup of things? Bob, boil it down for us. Help us to understand what the heck has happened.
Bob's got big muscles there.
Bob has got nice muscles.
Love the graphic. Yeah, so basically there's 2 broad sets of accounts that you can think of. There's your retirement account, your taxable brokerage account. Those are the kind of 2 big buckets. So the retirement accounts can either be employee sponsored, so employee-sponsored plans would be things like a 401k or a 403b or a TSP. And those are things that your employer will actually, help you enroll into. They will pick the platform, but they will provide you a list of funds that you can choose from to invest there. And then there is an individual retirement account or an IRA, and that's one that you can actually do on your own. You don't need an employer to sponsor you to do that. As long as you have earned income, you can actually start your own IRA. And then you can see in both of those cases, there's a traditional and a Roth option. The traditional option was, something that's been in place for a long time, where effectively you get tax deferred money. So you don't pay taxes and put your money in, and then you pay taxes on the way out. Roth basically flips that over on its ear and says, you know what, you can pay taxes at the beginning and then get tax-free growth and never have to pay taxes again. So those are options for some people's 401ks, not all, and that's an option for an IRA as well. And then your taxable brokerage account is where you would put money after you've filled up those buckets, those retirement buckets. And we have a flow chart, I think, later that will go through how you should actually go and actually order that money into the accounts.
I love that. Let's ask Monique a question.
Say that. So Monique says, my tax guy. Do I have a tax guy? I wish I had a tax guy.
Monique says, your tax guy.
Oh, thanks. My tax guy says that Roth IRA is a ripoff because I'll be at a lower tax bracket at retirement than I am now. So it's best to pay the taxes now. What are your thoughts on this, Bob?
Yeah, I think that's a great question. And it's a good distinction to think about. I think that for most people, if you're already in your higher earning years and you're already in an upper tax bracket, I agree. I think a Roth doesn't make sense. I think a Roth makes a lot more sense for people that are just starting out early in their career, where they're at a very low tax bracket, and they anticipate that in retirement, they're actually going to have a higher tax bracket. So I think you're getting good advice from your tax guy, because if you anticipate a lower tax bracket in retirement than you're in now, then yeah, you want to do traditional and not Roth. That makes sense to me.
I love it. I love it.
Thanks, Bob.
Thank you. Okay. So, like, we'll actually move back to this bit. What's the difference between all these accounts? And as we've actually been learning about this, we've actually seen there's a lot of similarities between the UK system and the US system in many ways. So what's the difference between all these accounts? Basically, it boils down to when you can withdraw the money, like what age you can get to it, and when they are taxed. So as we were just talking about, taxed before or taxed afterwards. So with Bob's help, we revamped our British slide and made it American to translate all of these different things.
What I realise is that we don't have the HSA on here. So let's go through what we've got on the slide and then let's quit out and ask Bob to tell us about the HSA accounts.
Perfect. So we've got the traditional 401k and you've got traditional IRA. Those are the traditional two ones. Basically, you contribute to them and your employer contributes to them, but you're contributing without tax, and then you pay tax at the end on both of them. So the tax comes at the end, the money goes in without tax, which is kind of like our SIP.
And when you say tax comes at the end, you mean when you come to withdraw, you pay tax on that withdrawal?
Exactly. Which is the exact reverse of the Roth 401k or the Roth IRA, which you've already paid tax on your money and then you contribute, your employer contributes and you contribute, but then there's no tax at the other end. So that's the kind of difference between the two. And then you have the taxable brokerage account where you pay tax, then you contribute, and then you pay tax at the other end. And obviously no one wants to be taxed at both ends.
Oh, Bob laughed.
Bob laughed. At least someone laughed.
I love it when people laugh.
It does amuse me, but no one wants to be taxed both ends. But like, does that mean we should avoid taxable accounts, Bob?
No, not at all. Not at all. The nice thing about taxable accounts in the US, especially for early retirees or retirees in general, is we have very generous long-term capital gains rates, federal long-term capital gains rates in the US. So Amy and I are actually able to recognize something like $90,000 worth of long-term capital gains at the 0% tax bracket. And then when you add our standard deduction on there, which is about 30-ish grand now, we effectively, that means we can get 120,000 out of our taxable brokerage on an annual basis without paying any federal income tax. So it is taxable, but when it's taxable at the 0% rate, that's a pretty good deal. That's
an amazing deal. And we are very jealous. Martin, the Rebel Ninja from the UK, who's helping out, who had a snooze and then got up to come and do this. It's like not like the 3K that we get in the UK. So you've got 120. The British people are like, well, we get 3K free. Thanks very much, British government. So another reason to love America. Definitely another reason to love America.
So, Bob, tell us about this HSA, how the tax works on those, because you said that it's like triple advantage. Triple
tax advantage. Yeah, so the HSA is a health savings account, and as long as you're in a qualified, high deductible health plan, you're able to make either a single, if you have a single plan, or a family, if you have a family plan, contribution to the HSA. And basically, you can think about it as kind of an IRA on steroids. So it has all of the tax advantages of an IRA, which is that the money goes in tax deferred, it grows tax free, and then you can pay taxes on it at the end, except for there's one additional advantage with the HSA, and that is you can use the money for qualified health expenses. So this can be for medicine or surgery or whatever. There's a lot of things that the HSA will actually cover. And when it comes out for a qualified medical expense, you literally pay $0 in tax on that. So it is the most advantageous tax-free savings account that we have in America. So I would say it's actually better than an IRA because effectively it turns into an IRA at the same age you can access your IRA funds at 59 and a half. So
Okay.
it's really good.
So if you don't use that money, like if you don't have cause, you're lucky enough to be super healthy and you don't need to spend that money on those medical expenses, it just kind of turns into
A retirement
account.
I mean, effectively, yes. I mean, it's still an HSA, but you can take money out just like you can an IRA starting at 59 and a half. Now, in that case, if you're not taking it out for qualified medical expenses, you're still paying taxes on it. But you know, you're in no worse shape than having put it in an IRA because it still was tax deferred and grew tax free.
Nice.
I love that. We're coming on to a few more of your questions. I'm seeing the questions coming up. Marta, we're coming on to some of the limits and the order to invest in a little bit. So for now, what we wanted to say is the brokerage account should not be avoided. Just use your tax advantage allowances first.
We'll come on to the order as well when we specifically which accounts shortly.
Exactly. So getting the money invested is the most important. So even if you have to invest in a taxable brokerage account, like that is still fantastic. And paying some tax equals you've made money. So that's okay. And the fact you have this long-term capital gains tax thing in America is just unbelievable. We're not going to sit here and get jealous. We're just going to appreciate that you're doing very well.
Can I ask Rhonda's question? So Rhonda says, don't HSAs have a use it or lose it time limit, or is that just my employer's plan? So they're saying, like, is there an expiration on this money that you're putting into your HSA?
Yeah, there's not on an HSA, but there's something, it's only one letter off. It's called the FSA. And the FSA definitely has a use it or lose it. So if you use an FSA, you actually have to drain all of that money out of the account every year, or you lose it. I learned that the hard way because I signed up for one of those thinking I was signing up for an HSA and realized that at the end of the year, I had used none of it and all the money went away. So yeah, definitely you want to use an HSA to actually save and invest. An FSA is a use it or lose it thing. So boo, I don't like those.
Boo.
Into the RFS.
The RFS pantomime type vibe. Yes, definitely.
What's a pantomime?
Oh, don't make me explain a pantomime.
Google on your own time, please. If you're not familiar with the British phenomenon of a pantomime, I encourage you to Google it after the session.
It's a Christmas show that our families go to every single year, and basically you boo the actors. Everyone has lines. It's the most ridiculous thing in the world, and it only exists in England, Britain. So if you go to a pantomime at Christmas. It's outrageous and hilarious. Okay, so let's go back to when can I get to my accounts? And you are charging through life happily across your timeline of your life. And there's a bunch of different times you can get to your account. So taxable, you can get to at any age. So if you're planning on retiring earlier, it's useful to have money outside the other accounts. Then we have the 401k, which you can get to at 59 and a half. We have Social Security, which is between 62 and 70. And Bob has told us there's a big debate over the optimum age at which to take your Social Security. And then we also have, interestingly, you can get to your contributions in your Roth account 5 years after you've started making it, which is quite an interesting sort of loophole in my mind, that you can get to that money earlier.
And actually, there's a bunch of ways to getting the money earlier, even for those ones that are later on. But that's advanced strategies. You can go and find some resources that we can point you to that tell you about all of those as well.
Yes, we will not be covering those today, but there are a bunch of advanced strategies, which ChooseFI has some fantastic stuff on, and many of the other places, which we'll come to in a bit. So if we were to boil down the accounts, you've kind of got the retirement accounts and the HSA, and then you've got the taxable account. Is that how you would boil it down, Bob?
Yeah, that's basically correct. And I think that, depending on where you are in your timeline and what your goals are, you can actually figure out where, to what you were saying earlier, Alan, maybe if you're going to be retiring soon, you want to get a little bit more money in your taxable account. If retirement is way off and you're anticipating lower tax rates in retirement, then load up your retirement and your HSA accounts and get as much tax advantage now as you can.
Love that. In the chat, Donna says your Social Security optimum age is only known after you've died. Which is so true. That's the hardest thing to predict. So basically, in these types of accounts, your retirement accounts, you fill it with one of the ETFs. The HSA, you kind of fill it with one of the ETFs. And then the taxable account, you fill it with one of the ETFs. That's the kind of simple overview structure to help us look at this stuff. So we have had a look at funds. We've had a look at accounts. Now we are going to move on to Katie's favorite slide from the entire deck, platforms. Why did you choose this image for platform, Katie?
We've got platform shoes. It's obvious.
So we have an eagle with platform shoes representing platforms. Let's look at the next decision level. Bob, what's the main 3 platforms that we can use?
Yeah, the main three platforms that I'm teaching folks at third decade about are Vanguard, Fidelity, and Schwab. Those are the biggest platforms in the US. They all have 0 fee. They mostly all have great customer service. The websites are pretty good except for Vanguard's, and Vanguard has been slipping a little bit on their customer service these days too, but Amy and I have accounts with all 3 of those platforms. There are a ton of other platforms out there. I would say the biggest thing that I try to teach folks to do is avoid any of the platforms that try to gamify investing. If there's fireworks going off and balloons flying in the air and big congratulations whenever you do something on the platform, that's kind of more like encouraging a gambling mentality. Steer clear of those and just go with a platform that is looking to be with you for the long term, so that you can invest and keep your money where it needs to be, so that you can hit financial independence at some point down the line.
I love that you perfectly filled the gap whilst our internet dropped out in Brazil, and then no one noticed, and we arrived at the perfect moment.
Tell us about there's hopefully you didn't do this, so forgive me if I'm asking something that you've already just covered whilst we dropped out, but what about all these, there's a bunch of other platforms, right? Like Robinhood and
Webull, Public, Wealthfront, Betterment. There's a huge bunch of other platforms. Shouldn't we be looking to have a robo-advisor and like gamified stuff and confetti when we buy stocks and shares? Like, shouldn't we be doing all of this?
Yeah, I mean, as fun as that is, it really rewards the wrong activity, right? Like, we should really just be buying and holding for the long term and not gamifying it. I think the robo-advisors are interesting. I trialed a bunch of them before I found the simple path to wealth. The bottom line is they invest your money in way too many things, and they charge you more fees than you should otherwise have to pay. So once I found the simple path to wealth, we closed all of our we had Betterment, we had Wealthfront, we fired our financial advisor because nobody needs an assets under management fee. And we really just went to this simple, in my case now 2-fund approach, but for most people that are still on the path, just a 1-fund approach, and you can manage it yourself and just stick with a well-known platform. Unless you're somewhere that you already love today and they're not charging you anything for it, I would never say such and such platform is a bad platform necessarily, but the big 3, if you're starting today, start with one of the big 3.
What do you mean when you say assets under management fee? How does that work, and why should I avoid it?
Yeah, for whatever reason, I don't really know how this ever came into being, but the financial industry figured out that they could get more money from people just by charging them a percentage in many cases, it's 1% or 1.5% of assets under management. So to manage your money, which again, it doesn't make any sense to me. Like, why would that be the case? It's not like, if somebody comes to clean your house, they say, well, how much money do you have? And we'll charge you a percentage of your money to clean your house, right? And no other thing that we do in our life do we pay a percentage of how much money we have for something to be done for us. So it really is highway robbery. You can go and actually map it out yourself on any investment calculator. Basically, go and put like, hey, I'm gonna earn 8% in the stock market over the next 40 years, and see what your final value is. And then put in, okay, what if I only earn 7%? And you can see the delta, and it is amazing how much money gets drained off. Because not only do you lose 1% per year, but you lose all the money that 1% per year would have compounded into. So yeah, steer clear of any sort of assets under management model.
I love that. And if you do want to see the impact, Katie created an impact of fees tool. So you can actually choose 2 different funds, 2 different platforms, not that you have platform fees in America, whatever. And you can also put in some advisor fees for your assets under management fees, compare the difference over time. Before we move on, there's a question that came in. Monique said, I thought J.L. Collins liked Betterment, freaking out over here. Tell us a little bit more about that, or do you have some calming words for Monique?
Oh, you know what? So let's put it this way. I don't think I've ever talked to JL specifically about Betterment, but if he's commented that, I wouldn't refute it. I will say that of all of the investment mistakes that we made, I don't think the robo-advisor is that egregious. We made a lot more egregious investment mistakes. So I'd have to look and see what Betterment is charging these days. Let's look up Betterment fees real quick. Betterment fees, because they might not be that bad, but the point is, yeah. So I'm seeing it looks like they charge a 0.25% fee for the first $1 million, and then the fee goes down from there. So again, it's 25 basis points. Listen, that's a lot less than what most people were paying 20 years ago, regardless of what they had, right? So on one hand, it's not that much. On the other hand, I would say you don't need it. So if you can take the training wheels off of Betterment, you could just move those funds, ACATS them if they're in your taxable brokerage account, because you don't want to incur any taxes for this, but you can ACATS it over to Vanguard or Fidelity or Schwab and then manage it yourself. And then you get rid of that 25 basis point fee.
Which fees matter?
Mm-hmm.
What's the next question, Katie?
Cynthia asked about TIAA, which I assume is a platform. She says, most of my funds are in there. Is it better to transfer to one of the big 3, meaning Schwab, Fidelity, or Vanguard?
Yeah, so where I'm familiar, I'm not that familiar with TIAA, but where I am familiar with them is I know some school teachers actually have that as like their employer retirement plan. So for anybody that is actively in a job, their employer retirement plan is picked, the retirement plan is picked by the employer. So you are basically, you need to stay with that platform until you've separated yourself from service. At that point, once you're no longer an employee, you can actually do a rollover IRA and you can roll it over to Fidelity, Schwab, or Vanguard. But while you're with the employer, you're really stuck at whoever they have you with. And if that's TIAA prep, you'd have to stay there. The good news is, likely, if you go looking at the funds, you should be able to find a low-cost index fund like we've talked about today to invest in, even on that platform.
Love it.
I'd like to draw attention to the fact that, like when Bob didn't know the specifics about some of this stuff, of like, oh, I wonder what Betterment fees are. You can just Google it and go to their site. So no one's expected to like have all this information in their head. You can go to the source to find out what the fees are. Often doing a bit of Googling around is like gets the answer to your question. Obviously, make sure you're going to a source that is correct. So going to the site itself is a really good first step.
Then it's useful to have like a framework to be able to understand the information again. So we have this little framework for choosing a platform, which is the number one thing is fees. And Bob just went and Googled the fees. That's the first thing. Like, what are the fees for investing? Number two, can you get the fund you actually want? Is the fund you want available? Number three, is the account you want available? Because some of them do HSAs, some of them do 401ks. Like, they're different accounts in different places. So can you get the fund you want? And then the final one, do you trust them? Do they have good customer service? Are they going to be around for a long time? Or are they some kind of like gamified flash in the pan? Here we are today, we'll take all your money and disappear. We want someone to be like round and solid. So that's the kind of the four criteria we use to look at that. And we've mentioned the whole asset under management fee. Before I say that, fund fees in America, like your platform fee should be basically zero in America. So if someone's charging you a platform fee, move on quick. Financial advisors, we've spoken about the assets under management thing. Bob, you said you fired your financial advisor. How did you find the courage to do that? How did the financial advisor take it? What happened?
Yeah, I think he certainly wasn't happy about it, right? But I have to say, even before, I found J.L. Collins's book, I was kind of underwhelmed because Amy and I we knew we might want to retire early, and we had some very specific questions. We had a meeting with this guy every 6 months. And I remember going to one of the meetings and having like a list of 5 questions, all of which he said, yeah, that's a great question, and I'll have to get back to you on that. And he never got back to me on anything. And it's like, you know what? We're paying an awful lot of money for you to manage our money, and you don't even get back to us on the answers to our questions. So the good news for me was the account that my advisor, the platform that my advisor was using was Schwab. So actually firing my financial advisor was as easy as calling Schwab and saying, hey, you see the financial advisor that I have on my account? I want you to remove access from him. I'm separating myself. And Schwab said, yeah, no problem. They pressed a button, and he no longer had access to any of my funds. And I don't remember, I did write him an email afterwards just to let him know that he had been fired. I don't think he ever got back to me.
It's a repeating pattern.
It's a repeating pattern, yeah. So take heart in that. If you need to get rid of your financial advisor, it's a lot easier than you think. And we had an article on the website about how to break up with your financial advisor that might help you if you do have palpitations about doing that. And on YouTube, Balloons has spotted that the last slide was indeed the St. James's Place slide. Boo, St. James's Place, which we understand Eddie Jones is like the St. James's Place of America, is what we've kind of learnt through some of this process of talking to it.
It's a very high fee platform.
Exactly. So let's move on to the decision level of platform. And basically, you have 3 incredible options. In America, you have Schwab, Fidelity, or Vanguard. Just pick one. Doesn't really matter, and move on with life. That's the plan. Okay. I will have to quit out to do that.
Bob, if you were starting from scratch, what would you do? Like, which platform would you go with and why? Because I know you've got your various platforms for like legacy reasons and things going on. But if you to start from now, what would you do?
Yeah, I think Fidelity has the most compelling option these days. If we were to start from scratch, I think we would go with Fidelity. The first thing is Fidelity actually has this really cool thing. In most brokerages, they have, you have access to like money market funds. Like, so if you wanted to keep your emergency fund in a high yield account, a money market fund would be something that you would do. But it's typically something you have to purchase. So you put the cash in and then you purchase it. Fidelity is doing this new thing now, which allows you to do a cash management account where literally when you put your cash into Fidelity, it automatically goes into the high yield option. So right now, I just looked it up. The Fidelity government money market fund is paying 3.94%. So, I mean, that's fantastic to earn almost 4% on your cash, and you don't have to buy anything. There's no buying or selling of that money market. It's just in there. The other great thing about Fidelity is you can have IRAs, Roth IRAs, and one very unique thing is the HSA. Most HSA accounts, because they came out of this kind of healthcare legislation, have very specialized companies that they only do HSA. And unfortunately, Vanguard and Schwab don't allow you to put your HSA there. So Fidelity is the only one of the big three that you can have all the account types that we talked about tonight and have it in one platform and manage it through one web interface while also earning really good returns on your cash by default when you put it in there. So I recommend all my third decade mentees, if they haven't started yet, start with Fidelity because they have everything you need, one-stop shop, really good interface, and great customer service. So if we were doing it again today from scratch, we'd go with Fidelity.
I love that.
We're very keen on Fidelity, Bob. Are you sponsored by them or have some kind of compensation for saying this?
No. I wish I was, but no, not sponsored by Fidelity. They're not paying me to be here tonight. We just really like the platform.
I love it. I love it. Christopher put a question in chat. Is this the case with all kinds of accounts in Fidelity? Christopher, just clarify the question.
I think we're talking about the money market.
The money market thing. Is that what it was about?
Yeah, if the question is about the money market, I believe that the cash management account is available for taxable brokerage accounts. So I believe that it's really a taxable brokerage account that has the money management. It seems like Fidelity is really trying to move more into banking. So they actually have things like bill pay, and you can, almost use it. I think there's an article over on the Finance Buff all about the new cash management features, and the Finance Buff has, kind of converted to moving over to Fidelity from a traditional bank. So I think that's the way they're moving.
Love it. Thank you, Bob. So if we were just to pull it all together into one slide to make it easy for you all to see, we would kind of go, well, your retirement account, your HSA, and your taxable account, just go with Fidelity. And if you were starting again, this is kind of what Bob said. If you're starting again, this is what you do. We also spoke to Brad at Choose FI, and he's like, you could just do it all on Fidelity. It makes it super easy. So there's a visual graphic of pulling it all together. Now, the next one, Sir Bob, is investing order. So how do you invest in accounts and which order you go through them? So we thought we'd bring this to you. So if you've got your dollars, you've created your gap, you've got some dollars, what order do you invest in the different accounts? Why do we start with the 401k, 403b up to match? What does that mean, Bob?
Yeah, so basically most employers in the US offer some sort of a match on your contribution to your retirement account. It might be, 1%, it might be 4%, but effectively what you're doing is you're doubling your money by getting your match. So just to make the numbers easy, if you're making $100,000 a year and your employer matches 4% of your contributions, when you put that 4% in, that $4,000 automatically becomes $8,000 because your employer made a matching contribution. And where else can you get a guaranteed 100% on your money? So that's why you want to make sure you always get your match.
Love that. So that's the first step. Then we switch to HSA, which is this triple tax advantage magical unicorn account.
Yeah, the big caveat here is you just have to make sure that you're in a qualified high deductible health plan. If that's not the kind of health plan you have, you're not going to be eligible for this. But if you are eligible for it, this is like investing in an IRA, except for you also get the benefit of taking money out for qualified health expenses for zero tax. So it is the best account, and that's why we switch from after the match, filling up your HSA.
Love it. Then third, we've got the Roth IRA. Why does this come in at 3?
Yeah, so the nice thing about the Roth IRA is, and again, this goes back to thinking about the timing of when you can get money out. this is going to allow you to, once you've established it, after 5 years, you would be able to withdraw money that you've contributed, not the earnings, but your contributions after 5 years. Now, someone did ask a great question earlier today saying, my tax guy said, don't do Roth because, he knows that I'll have a much better tax bracket in retirement than I have now. So this might not be the right thing for you if you are in the peak of your career and you're in a very high tax bracket now and you anticipate coming down. But certainly if you're earlier in your career and in a lower tax bracket, this may be the best thing, is to fill up your Roth, or if you want to access the funds earlier.
Love that. That brings us on to fourth. We're switching back to the 401k, 403b. Why do we switch back?
Yeah, so after we got our 100% match in the 401k, and in my hypothetical, we put in our $4,000 and we get the matching $4,000. Once we've filled up the HSA and the Roth IRA, it's like, well, where do we put the rest of our funds? We go back to our tax deferred 401k and we would add in the extra $19,500 so that you could completely max out your tax deferred retirement account.
We've had a few questions in the chat, Bob, saying, are we also including the 457 or 457B in that when you're talking about the 401k and the 403B?
Yes. So great question. Those are all different employer-sponsored retirement plans that would be analogous to the 401k, 403b. Yes.
And then we had a question or comment as well on the Roth, that the amount you can put in also depends on your income levels?
It does. So you can't, I forget what the cutoff is, but above a certain income level, you can't actually do a direct Roth IRA. You have to do something called a backdoor Roth IRA, and we can point you to Brandon, the mad scientist, did an excellent blog article on how to do backdoor Roths for high income people that don't qualify to do regular Roth contributions.
I love that. So let's move on to number 5. After you've done all of that, if you have dollars left over, you shove it in your taxable brokerage. Is that correct?
That's it. Yeah. So if you're following the Rebel Finance School and you keep creating a bigger and bigger gap between your income and your expenses, hopefully at some point in time, you'll be able to actually max out every single one of these and then get to the point where you're actually putting extra money into your taxable brokerage account.
That's fantastic. Little word of warning: if you're considering changing your taxable brokerage account, just think tax. And this is the weirdest AI generated slide I have ever seen in my life. I was like, please do the tax man collecting tax in America. And this is apparently what AI thinks it looks like.
It's a bit Ghostbusters.
It's a little bit Ghostbusters. And then if you look at the bottom right, there's a rat holding up another rat. I'm like, where did that come from? How is that related to tax? Don't get it. But Bob, just tell us why we've brought up the considering changing think tax.
Yeah, so the nice thing is, for example, like when I read The Simple Path to Wealth and realized, hey, I don't need to do any of this weird stuff anymore. I can just buy one fund and hold it forever and be okay. Those changes are very easy to make in your in your retirement accounts, because there are no tax implications. So you can go into your retirement account and make that switch, and it's not going to, change your tax situation for the current year. Not so with your taxable brokerage account. So you have to be mindful in your taxable brokerage account, anytime you sell anything that has a gain on it, you're going to have to pay capital gains taxes. And while we did talk about the power of the 0% capital gains tax bracket in America, that's generally only something that somebody in early retirement can access. So if your income is too high, you may be at the 15% or the 20% capital gains bracket. So you want to be mindful of making changes there and doing it in a tax efficient way.
I love that. Thank you for clarifying. That's fantastic. And as with everything, rules change, allowances change. You've got to stay up to date with this stuff each year. It's exactly the same. We spend hours updating the Rebel Finance Score course every year to make sure it's updated with all this stuff. But you've got to stay up to date with this stuff.
We're recording this in late July 2025. So if it's significantly after that, please do double check what the latest rules are.
So how do you stay up to date in America? Are there any good resources for Americans, Bob?
There are a lot of great resources in America. The Choose FI podcast is phenomenal. Afford Anything is great. Catching Up to FI is awesome. We have Jackie on today. Her and Bill do a fantastic job, especially for those that are starting late. There are tons of blogs, JL Collins NH. So if you haven't read The Simple Path to Wealth, his stocks series is online for free on his blog. Brandon the Mad Scientist. Carl from 1500 Days to Freedom. He's actually the one that gave me this picture back here of the bull. He's got an excellent blog. So there are so many resources, books. Jackie wrote a book, Fire for Dummies, which is phenomenal. There are really an incredible number of resources here. I think JL Collins and, of course, Mr. Money Mustache are probably the two big resources that most people know about. But yeah, we're pretty fortunate to have a lot of really good content creators in the space here in America.
Yes, when we first learned about this, everything we read was American, and we spent many months translating 401ks into British language to try and understand it all. So you have phenomenal resources in America, and there's all of the campfire events and all the different communities, the Choose FI groups in different towns as well. There's some great stuff. Spring says, but they don't have your lovely accents. Thank you for that. We love you too. And the Rebel Finance School, like basically up until week 8, everything of the Rebel Finance School applies no matter where you are in the world. It's just the week 8 stuff, which is why we now have the session. So we're like so grateful to have Bob here helping us. So grateful for that. Now, Bob, you had sort of a closing message for us. What was your closing message, and why have I got a picture of you with the large fish on the slide?
Yeah, my closing message is, I like to just follow JL Collins' Simple Path to Wealth. Buy as much VTSAX as you can, hold it forever, and then eventually live on it. So my dad and I'm super blessed. I'm 50 or 51 years old. My dad retired 3 months before I did 6 years ago. And my goal in early retirement was to be able to set my schedule up such that when I'm home on any given day, when my dad calls and says, hey, the fish are biting and the weather looks good tomorrow, do you want to go? I could answer yes to that question. So yeah, I am living proof that, you can just own one fund and fund your ideal retirement lifestyle with it. So
I absolutely love that. And it's so true. The one fund strategy, just investing your money, VTI or VT, whatever it is, and allowing it to grow over time. Like, it's created incredible freedom for us. And a bonus trailer, we have a special bonus session coming up with Bob. So if you've enjoyed listening to the dulcet tones of Mr. Bob Haynes, he is coming back on to talk to us about investor
policy
statements, which is a lot sexier than it sounds, and rebalancing and getting money out in retirement. Bob has a fantastic strategy that he taught us. We're like, this is so cool. We need to share this with the world. So we have that coming up. So please tune back in for Bob's one coming up. And before we say thank you to Bob, I did want to mention the Rebel Ninjas that are in the chat. Martin and Lisa, British ninjas, had a snooze and then got up at 1 a.m. to come and do this tonight. So Martin and Lisa, give them a round of applause. That is committed. And then we also have Matt in the chat, and Matt has very graciously helped us with the slides, commented on the slides, answered so many questions tonight. He's ML on YouTube. So Matt has done a fantastic job. He is the American Ninja. So American Ninja.
Isn't that a TV show?
It might be a TV show, but he is truly the American Ninja, the proper one. And then obviously we have Mr. Bob Haynes. Give him a huge round of applause. Bob, we love you. Thank you for helping with this. It's absolutely phenomenal what you have done.
Oh, and Jules has been helping out in the chat too, another Rebel Ninja. Thank you for pointing that out, Lisa. Hopefully we remember to acknowledge all the ninjas. There's so many that like they sneak in. They've got ninja-like skills. They sneak in under the radar and they do their helping and then they sneak off. So thank you to all the ninjas. You are wonderful.
Yeah, it's kind of such an amazing thing that you have this group of people that have learned about finance and then want to give back their time to help other people. Like, it's just such a gracious and unbelievable community that we absolutely love. And just from us Americans, we're actually coming to America soon. Not like the Eddie Murphy movie. It'll be very different. We're going to stay. We're not going to Queens this time. We're going to go and stay in LA for a couple of months. So if you happen to be in LA, we can say hello. We're also going to the Bogleheads conference, where we're meeting Bob at the Bogleheads conference, which is in Austin.
No, San Antonio. You keep saying Austin.
I knew it was in Texas.
It's okay. Basically the same thing, right?
Yeah, they're not that far. They're not that far from each other, Alan. You know, yeah.
It's so
between the two. Yeah.
Monique, yeah, just Google the Bogleheads annual conference. It's like at a weekend in October, so you can find it in there. Moria says, I'm in LA. Moria, let's hang out for coffee one day. It would be lovely to see you. And the resource Bob has on rebalancing, you come to the workshop in a couple weeks' time. If you're on our mailing list, you'll get an email about it. And we have that workshop coming up with Bob, so you can find it there. JC has said, San Antonio, woo, check out the Alamo and eat at the Nickel. Good stuff. So, Bob, we need to go to the Nickel to have dinner whilst we're there. I've never tried it. I thought a nickel was a coin.
Yeah. Sounds good, though.
So I think that's brought us to the end of tonight. YouTube people, thank you so much for coming. Marta, Ballum, Jane, JC, Morgan, who's not related to the Morgan Stanley Capital Investments, we found out, and to all of the people on the YouTube, thank you so much for tuning in. So YouTubers, we are going to say goodnight. Please hit like, please share this with anyone else you found in America as well. Thank you so much for coming. Bye-bye, YouTube.
Thanks, bye.
So there we go. YouTube has ended. You are now